All right, let's take a look at the futures one more time. Dow's indicated up by about 50 points. S&P futures basically flat. NASDAQ futures are down by about 14 if you take a look at what's been happening in the pre-market. Joining us right now to talk more about it is Marta Norton. She is Empower Chief's investment strategist. And Marta, you're convinced that basically everything in the short term is going to be riding on what happens with tariffs over the next week or two. What are the messages the market is waiting to hear?
Yeah, I think that's right. So, of course, we know April 2nd being D-Day or Liberation Day on tariffs. And I think what the markets are really going to be looking for is what is the strategy behind these tariffs? Are we getting clarity that these tariffs are clearly negotiating tools, which would make them short-term in nature and likely less disruptive? Or are we going to get more indications that these are a step in a seismic change in global trade and oriented more toward bringing U.S. manufacturing back home, addressing trade deficit, and creating that additional revenue for the federal government? And I think if we're looking at that latter possibility of focusing on those three objectives, I think we could be looking at tariffs that are broad-based in nature, that are longer lasting, and ultimately more disruptive to earnings.
More disruptive to earnings. So maybe that's the key. The market is really looking back to earnings once again, and we have to figure out how these tariffs are going to impact those earnings.
That's right. I think that's really, when we think about where tariffs hit first, they hit earnings first, and then it's on the companies and their ability to pass along those increased costs. And I guess there's some question marks there, both from the ability of the companies to pass them on, just from a demand elasticity perspective, and also just the beleaguered nature of consumers and whether they're going to want to stay the course and pay higher prices. But when we're looking at corporate earnings, we are seeing revisions in certain areas. So you're looking at materials, industrials, you are seeing earnings come down and maybe some realization of the tariff exposure there. But there are other places like technology where there is tariff exposure both on the cost side and potentially on the revenue side if we're thinking about a retaliatory situation. And yet we're not seeing much movement on earnings there. So I think there's still some hesitancy on the part of markets and investors to really incorporate a worst case scenario on the tariff front.
What are you telling investors to do in the meantime? Besides wait, are there areas that you think look safer?
Well, I feel a bit like a broken record and a bit tired here, but I think what we've been looking at 2025 is a year for balance over conviction. And that reflects the fact that we've seen valuations be pretty high across the board. And even after the technical correction, valuations haven't changed meaningfully. And so there's not a ton of areas where you could say, hey, that's something that's gotten really cheap and is a place to move in. There is one exception to that, and that's the small cap area. Now, small caps are really economically sensitive, so there's some risk there, but they've gone from being relatively cheap to cheap on an absolute basis. So the idea of judiciously adding to those places that have a margin of safety like small caps, I think makes some sense.